Hello and welcome to this edition of CAP STRAT this week. Mike, we got preliminary GDP last week. We've got a Fed meeting this week. Let's get right into it. So, preliminary report for Q1, gross domestic product, a little bit below expectations on a headline number. Economy struggling, so Fed's just going to cut, right? What do we think about that?
Yeah. Well, the news coverage has been that Q1 real GDP quarter over quarter annualized was 1.6%, cooler than expected. And the inflation within that report, the PCE price index, a little bit hotter than expected. So anyone who wants to write an article related to economic slowdown with higher than expected inflation, stagflation fears heading into an election, whatever, that's sort of what ended up happening. If you look under the hood, this was not a concerning GDP report at all. The way we look at GDP is you break it down by components. And if you take out the two most volatile components that over time add virtually nothing to GDP, they literally just create volatility around the quarterly number. Those are the inventory and the net export numbers. You take those two out, and what you're left with is the important stuff, the sticky stuff that gives you the true trend in the economy. So that's consumption, business investment, residential investment, and government spending.
Right.
Those collectively are referred to as real domestic sales. Real domestic sales came in at 2.8%. That is very healthy. You see the dark blue area is consumption. That came in a little lower than Q4 23, a little lower than Q3 2023. But still at a pretty solid run rate. Within consumption, it was a continuation of plenty of spending on services, a little less spending on goods. But overall, you look at that report, and to us, it's not that concerning. And the other thing, you just get one number for the full quarter. But if you look at the more higher frequency economic growth data points that come out monthly throughout the quarter, like retail sales, for instance, it shows the consumer in the U.S. economy actually had a good bit of momentum to end Q1 and probably has a good bit of momentum here in April at the start of Q2. And you'll see that now start to get reflected in a lot of the GDP nowcasts, the now track. So one of the most widely used is the Atlanta Fed's version, which is now tracking at close to 4% for Q2. It's really early, but it just shows there's definitely some positive momentum. So
yeah, you've got that momentum building up towards the end of the quarter and early into this quarter. And I mean, for those that haven't noticed, Rarey has completed his glasses buying process, so we would expect that to be reflected in the Q2 GDP numbers as well. So should be some nice support there. Lots
of free try-ons and returns back here.
Yeah, some of those volatility creators we talked about earlier,
Definitely.
Right? So you have this GDP report, right? Disappointing on the headline. But look at equities. Yeah. We've got a green week in equities for the first time in a little bit here. What is this? Is this just a recovery? Is this good news? Is bad news? How do we take this?
I mean, equities, not this past week, but the prior week, really ended the week with a whimper. And so you could tell as long as the GDP growth data came in okay, not a big surprise. And we're in the heat of earnings season. Earnings have generally been beating. Companies have been able to beat by a pretty good margin. The market was primed for a little bit of a recovery. Sure. Still firmly negative on a month-to-date basis, but just seeing a bit of a rebound here. And we have more Magnificent Seven earnings yet to come, or maybe now called the Fab Five. So we'll see how that evolves. But yeah, just a bit of a recovery week.
Yeah. So we talked about how some of the drivers under the surface led us to be a bit more encouraged about the GDP report. But one other item we've looked at here is this trend in savings, right? What portion of that consumption in Q1 has come from spending earnings, real wages, versus spending down from consumer savings? And you can see, that savings rate is starting to fall here in conjunction with that Q1 GDP report.
Yeah, we're getting back down towards levels last seen in early 2022 when consumers were spending down their savings just to try to subsidize their loss of purchasing power. Inflation was really hot. And so what you got was nominal growth was strong, but real growth was very minimal. So That's also been reported, and within the news articles about how weak the GDP report was. We would maybe not be as dramatic about this, but would tend to agree directionally. What this says to us is those real domestic final sales numbers we got for Q1, running at 2.8%, unless wage growth picks up or inflation comes down or both, in order to sustain that level of economic growth from here, consumers need to spend down their savings. They can't do it organically or naturally. So that has to happen, right? And if wage growth stays elevated, that's a potential problem for the Fed. If inflation comes down, that's not a problem for anybody. So there's a healthy way to go about this or a not so healthy way to go about this. But that leads us to believe that, Q2 may be hot, but unless something happens here on the wage growth or inflation side, consumers are going to be subsidizing their consumption through savings, or they're going to take on debt, but that's really expensive. That's not a reliable source of consumption at this point.
Yep, and it's certainly more expensive than it was, even a few years ago. And so maybe, said differently, the current level of real wages is not enough to sustain the GDP, the consumption growth that we've seen year to date.
Right.
So you break that down into the two sides, like you were talking about. Nominal wages have been growing at a somewhat healthy clip. Inflation, we've been talking about all year, is really the factor there that could move the needle of if inflation comes down, real wages grow, consumption would be further supported. Maybe consumers don't need to dip into their savings going forward. And to that point of inflation, that's been the thorn in the Fed's side for some time now, stickier than expected inflation. And what we're looking at here is we're trying to get a gauge on what the Fed is looking at. So we have what we call core CPI composite, core PCE composite. These are both on a 3-month annualized rate of change basis, but trying to look at things like supercore or things under the surface where the Fed is trying to gauge where inflation could be going. And this feels a little concerning to me, this recent uptick in some of these inflation measures, right?
You don't say.
Hot take.
Right. Totally going in the wrong direction. The Fed is great at taking the CPI basket and chopping it up in a million different ways. And if you exclude this and you exclude that, well, if you exclude all the things where there's inflation, it turns out you don't have any inflation, right? So they look at trimmed mean and they look at supercore and they look at just the core measures, the core sticky components, all of that. You take all of that together, despite all of that manipulation, totally going in the wrong direction on a 3-month annualized basis. You chop up the core CPI data points in the way the Fed normally does. You're looking at 6% annualized. And if you do it for core PCE, you're looking at 4% annualized over the past 3 months. So awaiting further evidence of inflation being on a sustained path towards 2%. Still awaiting further evidence.
Awaiting further evidence as we go into an FOMC meeting this week. Concluding on May 1st. And we would expect largely for this to be a non-event.
It's a snoozer.
Right? No expectations for a rate cut. That is that is off the table. Minimal expectations that they could guide towards a cut in June. They just haven't seen any evidence that would justify that. We would think the two potential surprises could be on the dovish side, Powell defending, quote unquote, the 331 dot plot, versus on the hawkish side, how open are you to hikes, given this inflation picture?
And that conversation, the potential for surprise, it's not going to come in the statement.
Right.
It's not going to come in the prepared remarks. It would only come in the press conference and how those questions would be phrased. Given, everything that's happened since the March FOMC meeting, do you still feel confident in the committee's median expectation of 3 rate cuts in 2024? And he's not going to say no, but he's probably not going to sit there and defend it. Right. He's going to kick that can down the road and saying at the June meeting, we'll have more evidence. We'll release a new summary of economic projections and a new dot plot. And we'll see what it says. So he's probably not going to, if you're looking for a dovish surprise, he's probably not going to take that bait and do it. And then on the hawkish side, it'll be some question of, given how sticky inflation has been and the reacceleration here recently, Is another hike this year something that the committee is currently discussing? Are you open to it? He's not going to disagree with the premise of that question. He will probably say something like, we're data dependent and we can hike if we need to, but monetary policy is in a good place. We feel like we can just leave the Fed funds rate where it's at until inflation comes down to our sustainable 2% target, and then we can cut. So he's probably not going to take the bait there either. So probably not going to get many surprises there.
Right.
And now we look at everything that's happened with inflation and the Fed talk over the past few months. What's happened is on January 12th, 2024, the market was expecting the path of the Fed funds rate through next December 2025 to look something like this.
Yep.
An immaculate disinflation.
Nice and smooth. Yep.
And now here we are. The dark blue line is where we're at today. Almost no cuts to speak of. The first cut getting priced in not until December. So higher for longer. And this difference is pretty big. You look at what the market expects the December Fed funds rate to be now versus back in peak immaculate landing time periods. That's a big delta there. The delta is even bigger as you look out to the end of 2025. We're talking about a 1.5% change in expectations.
Yeah.
And this is a big reason why we have formally, internally at least, I guess externally now we're doing it, declared we are no longer in an immaculate landing market regime. This has gone on for too long, and the inflation that we've seen over the past few months lead us to believe we're now firmly in a no landing market regime,
Right.
which means a lot of different things. We'll unpack it in a future video shoot, but the inflation data, the expectations for Fed rate cuts, the bond yields, treasury yields that we're seeing, all
Right.
consistent with the no landing. The things are not yet consistent are equity prices. If
Credit
we're in a no
spreads.
landing, they probably need to get cheaper
Yep.
to take into account these higher interest rates, and then credit spreads. As
Yeah.
you said, they're too tight. They probably need to widen out to reflect the fact that this blue line means a lot tougher borrowing and refinancing conditions for corporations than this purple line did.
Yep.
If we have this blue line, much higher probability that somebody's going to default.
Yeah.
And so investors should demand a higher yield on corporate bonds than they are today if this is the reality.
Yeah. Absolutely. This is a shift. This immaculate landing, from a corporate financial management standpoint, this is kind of a let's manage our cash flows, let's hold us over until the Fed gets back to a more normalized federal funds rate. This is more of a continuation of a new norm, right? That
Yeah.
higher for longer idea that, could certainly impact financials going forward.
And this is only like in 3 months.
Yeah, this is a
Right?
significant
Stay
significant
tuned,
move.
everyone,
Yeah.
because 3 months from now, we could totally be down to this purple.
Yeah.
This is like saying the world over the next 2 years is going to be a totally different place. And we arrived at that conclusion based on 3 months
Yeah,
of data
and you have
and
this-
some Fed talk.
This dynamic of cuts are going to beget more cuts. So once the Fed does cut, the market is going to be looking for more of them.
Yeah.
And this line could move pretty quickly. But you mentioned, and we'll definitely unpack this more in a future video, but we have this interesting dynamic where economically speaking, we're pretty healthily in that no landing type environment, but market-wise, to your point, there's still room for movement. And we've seen some of that on the Treasury side, to your point, where the Treasury market is trying to adjust pricing accordingly to this new expected federal funds rate. And
Yep.
that's where you can see 30-year down 1% last week as yields rose, down 10.5% year to date.
Yep.
I mean, these are significant adjustments to expectations.
And usually in terms of order of operations, Treasury yields are one of the first financial instruments to price in a change in regime. And then as you get the 10-year, moving up towards a 5% yield, that's when all of a sudden the momentum for equity starts to slow down, and
Right.
you're much more likely to have a sell-off.
Right.
All that said, a no landing market regime typically lasts 2 to 3 months, which sets us up for, if the Fed is still able to cut in July, which we're barely holding on to as our base case, then this could totally flip.
Yeah.
And the things that sold off could look very attractive.
Yeah.
And the year is long.
Yep.
So
Yeah. And so we talked about how, this meeting this week likely to be a snoozer, right? But for the real Fed watchers out there,
That's right.
Those that like to get into the details, there could be something for us this week, right? Talking about the balance sheet runoff and pausing the balance sheet runoff. Do you want to talk about the potential dynamics there and maybe how the Fed could use an otherwise quiet meeting to make a change here?
Yeah, there's a 0% chance that they cut rates, but in our view, it's about a coin flip's chance that they announce they're going to start reducing the pace of the balance sheet runoff. As a reminder, they're currently shrinking their balance sheet by up to $95 billion per month. That's a form of tightening.
Right.
It's different, but should have similar impact on the economy and markets as hiking interest rates or leaving them high for a long time. It's just a different flavor of tightening. And so they could be reducing that tightening. They set it up in the March FOMC meeting minutes. It's totally possible, as they say, this is a quiet meeting. Let's try to generate some buzz.
Get those clicks.
And start that process. So that would be a positive.
Yeah.
That directly flows into our money supply forecast. That is helpful. On the margin, it's not as helpful as a rate cut, but it is somewhat helpful. It's in the right direction.
Yep, that would be somewhat supportive of liquidity, certainly. We'll wrap up by checking in on our recession signal. Remains inactive. We've actually lost a couple of yellow line items from last week, so some improvement there. One new red here, heavy truck sales down 11%, the 3-month moving average. Not much to report on here. To the point we talked about, the market's still kind of in that immaculate landing, flirting with the no landing type scenario. Recession signal remains inactive. Yep. All right. Well, that will do it for this version of CAP STRAT this week. If you have any questions or comments, please feel free to reach out.